Good morning. Welcome to Trading Hour. I'm Reema Tendulkar, and for the markets, the benchmark indices are holding up in the green. It's up 70 points on the Nifty. The Sensex has gained close to about 300 points. The morning so far this Tuesday has been fairly steady. But like yesterday, there is some pressure in the broader markets. The mid-cap index is down 0.5%, and the advanced decline ratio, if you can pull that up, that has close to about 2,000 stocks currently in the red. So the broader markets are still a bit stressed. Let's quickly run you through the stocks which are helping hold up the markets. If you pull up the contribution plate, you would see that it's just 3 stocks: Reliance, Infosys, and ICICI Bank. Now, these stocks have closed about a 25% weightage on the Nifty, and they are contributing to a bulk of the gains. In fact, these 3 stocks, Reliance, Infosys, ICICI Bank, in the contribution plate will tell you, are holding up the Nifty by more than 50 points. And the Nifty is up close to about 65 points. So, nearly 75-80% of the Nifty gains are courtesy these 3 individual stocks. IT is providing the bulk of the leadership today. The Nifty IT index is a gain of more than 1.5%. So it's across the board gains, right? It's Infosys, TCS, Tech Mahindra, Wipro. These stocks are leading from the front. It's also a big day in terms of Qs. You've got the India WPI inflation print at 12 p.m., especially after the shocker that we got from CPI. This one's going to be tracked very closely. It's the Fin Nifty expiry today. Every Tuesday, you've got the Fin Nifty contract expiry. 5 Nifty companies report their numbers: Adani Enterprises, Apollo Hospitals, Eicher, ONGC, and Grasim. 5 of them. And many in the broader markets, many of them are F&O names: Bata, Bharat Forge, Biocon, Bosch, Vodafone Idea, IPCA, NMDC, PI, Siemens, Torrent. The list is very long, but it's going to be, we're right at the fag end of the earnings season. And today you're going to get a whole host of mid-cap earnings. But the big one is going to be the US CPI inflation print. It comes out at 7 p.m. India time. But we've got a packed trading hour for you, so let's kickstart the show with some stock-specific action. So Zee Entertainment is under pressure post its Q3 earnings. Ad revenue growth, that is the key metric the street tracks, and that's down 16% on a year-on-year basis, though on a quarter-on-quarter basis, it is showing an improvement and a pickup of 5%. Vahishta is here with the fine print. Vahishta.
Hi, Reema. You're absolutely right. It's been yet another weak quarter for Zee. In fact, the revenues have been flat, which was led by elevated investment in content and marketing costs. The EBITDA margins have contracted as much as 600 basis points on a year-on-year basis. Additionally, the provisions, which are totaling to 169 crores, were made in this quarter, which led to a drag in their profitability. As you mentioned, advertising revenues were down 16% year-on-year basis, which was led by the free channels, withdrawal of Zee Anmol, and curtailed ad spends by the largest sector, which is the FMCG sector. Though the positive was in the subscription revenues, which grew by about 13% on a year-on-year basis. ZEE5 revenues have also grown 33%, but their EBITDA losses have widened further to 282 crores. Zee's All India network share has also contracted and is now at 16.2%, which is one of the lowest in many quarters. So yet another weak quarter, but the silver lining, of course, is on the merger with Sony. And the street is going to be closely watching that because the NCLT hearing is also today. In terms of brokerages, I would say Citi has said that FY 24-25 earnings estimate has been reduced and is lower at 11 to 15%, and the target price has been cut to 280 rupees. CLSA has a target price of 325 rupees, while Elara Capital is quite optimistic and says that the target price is 390, factoring in the merger synergies. Back to you.
Thank you very much for that. The Zee-Sony NCLT merger decision is going to take place today, as Vahishta said, and that's very important. And one of the exceptional items that the company took was related to merger-related costs of nearly 69 crores, and that was one of the exceptional charges. Let's talk about Nykaa. That slumped in trade after margins come under pressure in the third quarter. Mangalam is here to tell us what the brokerages are saying. Mangalam.
Well, as far as Nykaa is concerned, the revenue growth of the company was pretty much in line with what the street was anticipating. However, it was the composition of the revenue growth and its resultant impact on the margins that has the street and the brokerages worried. If you just take a look at what Goldman Sachs has said, they've said that they've been positively surprised by the acceleration in their fashion business, which grew at around 50-odd%. But the BPC segment, beauty and personal care, which is the core of the business, grew just 26%, and that was a negative surprise. However, they have a neutral rating on the stock with a target of 200 rupees per share. Another company which has 200 rupees per share as the target on Nykaa is Jeffries, which has a buy rating, and they say that the gross merchandise value growth was led by fashion and others on a low base. Other segment actually grew over 250 odd %, and the BPC or beauty and personal care grew 25%, largely due to a high base and shift in the festive season. At the same time was impacted a little by the weak demand. Overall, the gross margins of the company were below expectations because of inferior mix, the discounting that the company had done, and because of weak demand environment, some down trading that took place by customers as well. As the company continues its investments in e-B2B offline expansion and own labels, this is something that they will watch out for. And finally, we have Nuvama, the erstwhile Edelweiss, has cut the target price from 251 to 195 because of lower EBITDA expectations. So they've lowered their EBITDA expectations by about 8% for this year. But importantly, in their model, they've upped the cost of capital assumption as well, as a result of which the discounting factor has increased, and that has led to a lower target price for them.
Okay, thank you very much for that. Some stocks which are moving around. So Adani Ports has recovered 4% from the day's low, is now back in the green, a gain of 1.5%. City Union Bank was down 15% yesterday as slippages rose very sharply sequentially. But we had a chat with the management and they indicated that this was on account of the NPA divergence, the increase in slippages, and the slippage ratio will moderate in Q4 and go back to historical levels. So the street is now taking note of that guidance on slippages going forward. They were also confident about maintaining NIMs at the current level. So that's another stock that we are watching very closely. And Balkrishna Industries, on the flip side, continues to see selling pressure, down 2.5%. RHI Magnesita is under severe pressure, down over 6.5% after reporting its Q3 numbers. Nigel is here with the fine print. Nigel.
Well, there were two problems with the numbers. One was in terms of the results that they reported. On the top line, there was, good growth of close to 20%. The problem is there was the degrowth of close to around 13%. So clearly, raw material costs are hurting them. And that's why margins came down to around 14% on a year-on-year basis. A weaker operational performance led to the profit number as well coming sub 60 crores. Now, if you look at the margin performance, well, it's the lowest margins that we've seen all the way since the September 2020 quarter, when they delivered margins of close to around 14%. So the trajectory should come up for you. From around 20%, it's come down to around 14%. The second problem is that the fundraising plans. They've announced that they're looking at raising equity probably to the tune of close to around 1,500 crores. That was approved, and that's a bit of a worry because that would mean a dilution of more than 10%. Remember, they have been doing some inorganic acquisitions, but the street was okay with them raising some debt. Why dilute to such a large extent? So that seems to be a bit of an overhang and explains why the stock is under pressure.
Thank you very much for that. Get into a break. We'll come back and discuss commodities. Manisha Gupta joins in next.
Welcome back. Here with us on Trading Hour. The equity market's doing quite okay, 0.5% higher. Let's talk commodities and figure out what's making headlines over there. Manisha joins in as always, and today she's focusing on aluminum. Manisha, good morning.
Morning and thank you, Vili. Yes, aluminum prices are trading near 5-week lows. We did see prices decline quite sharply in the last couple of sessions. It actually has been a trending down line for last 3 weeks now. Some bit of a gain coming in on your screens. That is because the China new bank loans for the month of January have hit a record at around $720 billion. And that is what seems to be giving some support to the prices there. But apart from that, when you look at the inventories, those have continued to gain. If you look at LME, since the Feb 6th, we have seen LME inventories gain up by nearly 50% for aluminum, and the Shanghai inventories have gained up by 180% since the end of December. So higher inventories mean that on-ground demand is slightly on the weaker side. Aluminum actually started this year on a bang because we did see supply concerns and inventory concerns coming in from Europe and China as well, and much of Asia. But those numbers seem to be improving now in sense of supplies but not demand, and that's weighing onto the prices right now. So when you look at a week-on-week basis, we are down by 3.5% now. On a monthly basis as well, aluminum prices have turned negative, down by about a percentage point.
Okay, thank you very much for that. Time for a short break. When we return, we'll be joined by the management of JBM Auto to discuss their Q3 numbers. Welcome back. As I said, today is an earnings-heavy day. 5 Nifty company report their numbers. They include Adani Enterprises, Apollo Hospitals, ONGC, Grasim and Eicher Motors. So let's talk about Eicher Motors to understand what the street is expecting, what the consensus expectations are. Sonia joins in with the key numbers. Sonia.
Well, thanks a lot for that. So, Eicher Motors is in a dream run of sorts with its Royal Enfield business. The business has picked up in a big way, and the new Hunter, which they launched, have given them really good volume. So this time around, the numbers are expected to be very strong. So if you look at it, it's the 4th consecutive quarter of rising Royal Enfield sales. It's a growth of 31% on the quarter that we're expecting year on year at 221,000 units. Now, as I said, the newly launched Hunter 350cc has done very well, and that, along with the easing of the chip shortage issue, is something that will lead to a good performance for Eicher Motors. However, exports have been on a decline. So export sales are down about 22% quarter on quarter because of a slowdown in the European region amidst rising inflation. The average selling prices will remain flat on a year-on-year basis because of this. Now, the Volvo Eicher business has also done quite well, as we've seen a pickup in CV volumes. The margins are set to improve on account of lower raw material costs. If you look at the Royal Enfield volumes itself, 4 quarters ago, they were doing on an average around 170,000 units. Now that has risen all the way up to 221,000 units. But this may come at the cost of margins because the Hunter, which is a newly launched 350cc bike, is a lower priced bike. So the blended margins may be impacted. So here are the numbers that we're looking at. A strong revenue growth of 30% is what we're factoring in at about 3,714 crores. The EBITDA will go up by 52.4%. The margins will still improve because of, same time last year, the margins were around 20%, expected to go up to almost 24%. And the profits will rise by about 60% or so. So all in all, good set of numbers, and the stock is very quiet ahead of its numbers today, but decent showing expected.
Okay.
All right, got that. Thank you very much for the details. I will watch out for Eicher's numbers. Right now, it's time to get back to the market and get a couple of trading ideas going. We have Mitesh Thakkar joining in for exactly that. Mitesh, good to have you back. So, we're seeing some incremental moves, at least on the large cap space. Mid caps continue to be under pressure. Banks, are kind of in no man's land. What are the trades that you would go with, or any advice on the index, if there's a trade on the index as well that you have?
Good morning. So I think, on the index, we've maintained that we'll possibly be ranged, and after hitting the lower end of the range, which is around 17,700 last week, we actually got below that on an intra-week basis, but didn't close below. So 17,700 and 17,950, 980 is the range which I'm looking at, and we might actually head towards the upper end of the range. So I think while the banks are not participating, it's IT and a couple of other large caps which are participating, and maybe that's where that's how you'll approach picking up stocks for trading. ITC has given a good breakout today, so that's a buy with a stop at 375 for targets of 400. And on the banking side, IDFC First Bank is looking slightly negative. So we'll advise a short here with a stop at 58 or just above it, maybe 20 paisa above it, and a target of around 54 to about 53.5 on the downside.
Okay, thank you very much, Mitesh, for that. Get into a break. On the other side, we'll be joined by the management of JBM Auto to discuss their Q3 earnings.
Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC-TV18. For the markets, we are seeing a 92-point gain on the Nifty, so pretty much at the high point of the day. The Nifty Bank is also just about broken back into the green, so we're seeing around a 20-point uptick there. But it is the mid-cap index which continues to drag, so right now it is down around 0.4%. We will talk more about the markets in just a bit, but let's get some corporate conversations going. Our first guest on the show is JBM Auto. It's on our radar after the company posted a strong set of Q3 earnings with a revenue growth of 16% and operating margins of almost 11%. So to discuss more on the numbers, we're joined by Nishant Arya, who's Vice Chairman and Managing Director of JBM Auto. Nishant, thanks a lot for joining us. This is Pavitra. So, like I was pointing out, your revenue growth looks very strong. It's around 16% for this quarter. If I look at the 9 months of FY23 together, it's at around 35%. What do you envisage for the full year for all of FY23? What is the kind of revenue growth that you think you could do?
No, so we are looking at sustaining the same revenue growth which you see for the 9 months, which is about 35% on a YOY basis. So we'll be looking at more than 4,000 crores of top line for this financial year.
Nishant, your OEM division has seen a slowdown. Your revenues are down 34%. At the EBIT level, it's down 64%. What explains this?
No, so in different cases, when we deliver our buses to customers, so they push it out by a quarter or two. So on an annual basis, it would not make much of an impact. It is just a quarterly activity because when different depots and other customers are not ready to take delivery, they get deferred. But as a whole year, it is intact. And on the other hand, we are working on a strong order book in all our businesses, like the component business. The operating profitability has increased by about 50%, and the top line has increased by 22%. And similarly, in the tooling business also, the business has increased by about 15%. And this particular quarter in the tooling business has been the best quarter ever in the history of the company as well. So that clearly positions the company that in every business we are proceeding further with a very high growth opportunity.
But Nishant, should we read this deferral of your EV bus orders? Does it signal any kind of slowdown? Is that how you would read it? And what would be the EV order wins or the order pipeline, and how would it compare with 6 months ago?
No, so definitely the order pipeline is increasing. We are targeting about 5,000 numbers for the next financial year. And definitely there is no slowdown of any kind. And we are seeing a huge interest by all the customers and very strong growth opportunity. And we'll be emerging as a market leader in this space and really meeting all our customer requirements, whether in the private segment or in the STU segment.
Nishant, hi, morning. So I just have a slightly more futuristic question on EVs, and that's clearly a focus area for you. Now, as of 9 months, you've done a revenue of almost 2,850 odd crores. As the year winds up and you look at FY24, as part of your revenue pie, how much is going to come from the OEM business and from EV buses really? And what does that do to the blended margin of the company? Right now, you're just under 11%, actually 10.2% as of 9 months, I believe, operating profit margin. So what does the scale up of the EV business do to the blended margins, and what part of the pie, or what percentage of the pie will it be?
No, so definitely we would be looking at taking up the margins at a blended level up to about 12 to 12.5% for JBM Auto as a whole. And the EV business would definitely be crossing about 1/3 of the revenues for the next financial year.
This financial year itself, it'll be 1/3 of the revenue. And if you could just give a breakup, I'm just trying to understand. So total company level, you're targeting 12% plus margin. But EV buses, I mean, how do the margins compare with your core business?
No, so we are having similar margins or a little higher margins in the EV bus business, which you even see here. So about 15 to 17% is the margin level in the EV bus business, where we have our EV operations and EV manufacturing put together.
Okay, Nishant, since you're saying that this will come through by the next financial year, where it will be 1/3 of the revenue, can you tell us, ever since we spoke last, have you added any more EV orders? Because the last time we spoke, you said around 500 to 1,000 vehicles for EV and CNG buses, but is the kind of order book that you had. Have you added more since then?
Yeah. So that's why I'm talking about the 5,000 numbers for the next financial year, because in the EV business, you take 6 to 9 months after getting the orders to execute them. And when they are larger numbers, then definitely the customers also have to be ready with the infrastructure as well as the people, the drivers and everything else. So that is, keeping that in mind, I'm giving you the whole purview of the next financial year for about 5,000 buses, which we're looking to deploy.
I just saw a headline in the papers today that BEST is looking to induct electric double-decker buses in its fleet, and the boarding should happen, just this week. Are you catering to this kind of demand? And also a word on the margins. Very interesting. Your EV bus margins are 15 to 17%. Will they stay at these levels?
Yeah, definitely. Because see, we are a technology-driven company. And as an organization, we are seeing that how we are delivering cutting-edge technology to our customers on an ongoing basis. And therefore, our R&D team is developing new technologies, which is delivering higher level of efficiencies, as well as very frugal solutions to the end customers, which is enhancing their total cost of ownership, which drives the profitability of the company here.
So EV margins should sustain at 15 to 17%. And are you participating in this electric double-decker buses opportunity?
Yeah, we are participating in multiple tenders of BEST and with different STUs across the country. And definitely we define our core solutions like recently with the similar to double decker, the coach which we have launched, which is India's first electric coach, which can do 1,000 kilometers a day. And so that has been our endeavor, that how technology can drive value in such cases. And clearly customers like BEST are looking for those kind of products.
All right, Nishant, we'll leave it at that today. Thank you very much for joining us. That is the management of JBM Auto talking about, their order book going forward and where they really see the year end. They are looking at a top line growth of 4,000 crores. EV bus orders have also really picked up, and for the next financial year, it should go up to 5,000. The stock is also up in trade, around 3% higher as we speak. We are going to get into a short break now, but when we come back, we'll talk all about the markets. Amit Khurana of Dolat Capital will be with us.
Welcome back. Decent first half, at least, for the market, so it seems. We're retaining most of the gains, and, we've got a good sort of bunch of large stocks which are keeping things higher this afternoon, almost touching the afternoon. Infosys, TCS, for instance, Reliance, quite a few of those stocks are still holding very well, as is ITC. That one continues to march ahead. Well, with that, let's actually turn our focus to our next conversation. It is a more market-specific conversation. Amit Khurana, head of equities at Dolat Capital, is with us to talk about the fundamentals and the road ahead. Amit, great to be speaking with you after a while. Good to be catching up. So you tell us, it's been a little bit of a tough start to 2023 for investors. We haven't had a runaway wild rally. We've been underperforming a lot of the other markets around Asia in specific. What's the course looking like to you from here on?
Thank you. Good to see you back, Surabhi. Glad to be here. We put out a note in November where we called the first half of 2023 more of a bottoms-up story, and as a best-case scenario, a flattish kind of a return on the Nifty and the main board indices, so to say, for India specifically. So just to put it in context, India outperformed by a huge margin last year. So I guess some normalization was in order, which we are probably going through right now. When you look at the big drivers on the macro side, I think they continue to be, shall I say, dichotomous. Why? Because inflation comes off a little bit, then it goes up. So that's very, very difficult to make a call as to what the terminal rate for interest rates will be. But we still maintain that we're probably in the final one round or possibly done away with it. I think that's a big direction that the market is looking out for. And then, of course, the earnings trajectory, which has been slightly, shall I say, lower than what we would have thought for the quarter. So we had more downgrades than upgrades in the earnings season, which is just getting over today. And I guess market is looking for more directional clarity as to how the FY24 earnings will look out for. So ballpark, I think the scenario does not change from what we have seen in the first 6 weeks of this calendar year. I think this will continue to be the situation at least till the time we get Q4 out, which is April, May. And hopefully by that time, we will have much better clarity on how the global macros work out. But having said that, I think the sector-specific, stock-specific opportunities continue to be pretty attractive, and that is where our bigger part of the focus is in our client conversations.
Okay, hi Amit, thanks for joining us. So you said, sector-specific stock-specific opportunities continue to be there. Is there anything new that you've identified? Because the last time we spoke, you said you like banks, you like IT, and you like capital goods, and you would avoid metals, chemicals, and autos. Does that still hold, or have you made any change to this kind of sector preference?
Well, largely it holds. I think we've also started looking at Elco far more constructively because a lot of local level, state level issues have started getting resolved in terms of price hikes playing out. So that's one category which we believe structurally extremely bullish. And with this price hikes, FY24 visibility only gets stronger. So that's one new category which I may like to highlight. And then, of course, you have specific cases within IT services also. For example, RateGain is one of the names that we've started, getting very positive about in the sense that the margin trajectory is now, as per the management guidance, showing an upward trajectory. So that is another one that we like. And as a category, I think over the next couple of quarters, you will see the domestic consumption plays coming into picture far more actively. So that's something that we are also looking at far more constructively than what was the case, let's say, a couple of quarters back.
Pharma as a sector per se has seen a lot of misses this time in earnings season. And some of the places where we've seen a miss or disappointing earnings has been, say, an Indoco Remedies. That's a stock that Daulat Capital has been recommending. It's one of the stocks on your buy recommendation. What have you made of the pharma earnings? What are the key takeaways, the big trends to take forward into the next couple of quarters? And have you altered your view on any of these stocks?
Well, big picture, I think the pricing pressure has probably worked out far higher than what our initial expectation was. But having said that, we also feel that some of the local exposed domestic focused portfolio companies will probably be in a better position because the price hikes for India market have started materializing, and hopefully that should be a tailwind as we speak. So overall, our take on pharma continues to be extremely constructive and a very, very attractive valuation. Some of the companies now reporting early 20s kind of valuations and ROEs which are high teens. So I think a lot of correction, both time and value-wise, has taken place. While there have been some disappointments for sure, but I think the overall structural play for FY24 and 25 visibility continues to be largely in place as per our understanding. And therefore, we continue to be extremely bullish, extremely positive about largely the space in general.
Which are these domestic pharma plays where the valuations are attractive, according to you?
Well, Cipla is one name which is amongst our universe of preferred picks. So that's one specifically. And as you highlighted, Indoco as well. Obviously, having said that, there are JB Chemicals is another name that we like because it's a mix of both domestic as well as the outsourcing story. So these are the three specific names that I would like to highlight. Some of them do qualify for our coverage universe as a preferred pick, while others largely remain a buy or an accumulate from our rating perspective.
Got that. Amit, are you, this whole conversation about the path to profitability, are you convinced with what the likes of Paytm are now saying, or maybe PB FinTech? What thoughts here? This has been quite a talking point in the market last couple of days.
Well, we were probably too early convinced, so we did take a bit of a rant on that. But I think that largely the direction for the business has turned out quite constructive, and we started calling that out after the Q2 earnings. But Q3 was very clearly a surprise for everybody, including us. I think the bigger picture is that there's a clear intent on part of the management to highlight what specific steps are being taken to get to the profitability part. And I think the investor expectations have also got significantly redefined. From a scenario for 2021, when anything which was doing concept selling was you could buy it at any valuation. I think those expectations have got significantly realigned to more the reality on the ground. So Paytm is one of the fintechs, one of the digital plays that we feel extremely positive about, and in fact that's the only one which we are actually positive on. Rest of the other players we still find significant challenges to the operating metrics, and therefore we only prefer Paytm at this stage on this particular sort of sector, so to say.
Well, on Paytm, they have a target price of $12.50. Is that right, Amit? So you expect Paytm to double from these levels?
Yeah. So if you look at largely the next 2 to 3 years of trajectory, you could be looking at an EBITDA, which would be very, very materially different from what we are looking at here. Obviously, the proof of the pudding is some evidence of that working out and the regulatory environment continuing to stay conducive. And you will eventually see the lending part of the business, the distribution part of the business being a significant driver of the earnings as we project them to be today.
We leave it at that. Amit, thank you very much for joining in. Get into a break. On the other side, the management of Godavari Power and Ispat will be joining in. Power and Ispat is the stock which is on our radar. They've posted a weak set of earnings in Q3, decline in revenue and margins. Pellet realizations have improved quarter on quarter, but it's lower on a year-on-year basis. To discuss the numbers, we're now joined by Abhishek Agrawal, the Executive Director of the company now. Abhishek, morning, and thanks so much for joining in. Could you tell us what the current realizations are for pellet prices and how would it compare with the average in Q3?
Hi, morning. The current explanations for pellet are about, say, 10,000 rupees for the normal pellets, 63, and for the high-grade pellets, which we sell, is about 11,000 rupees explant.
Is an improvement that we continue to see on a quarter-on-quarter basis, right? So Q4 should be much higher than Q3.
Yeah, Q4 should be higher by at least 20% compared to the pellet prices, compared to Q3.
All right. Hi, Abhishek. Thanks for joining us. This is Pavitra. So, can you tell us what percentage of your sales volumes will really be impacted if we do see higher realizations? What percentage of your sales volumes actually get impacted by that?
See, on the high-grade side, we produce about 65% of the entire volume. And with current volumes, we estimate we will produce about 7 lakh tons. So about 4.75 lakh tons should be of high grade, which will be sold in the market, with a realization of about, say, 11,000 with explant in Q4.
Okay. Got that. I'm looking at Q3 margins, Abhishek. You're at 11.8% for the third quarter. It's been very it's a far cry from obviously last year. What's the outlook? All things put together, or what are we looking at in the fourth quarter? And you mentioned the pricing on the pellet side. What about, say, the first half of next year?
See, on the Q3, the margin on the lower side, definitely because, of course, the duty was removed in the month of November. And we usually carry an order book of about 45 days. So the pellets were already sold before the duty was removed. Secondly, there has been impact on the energy cost. As you're aware, the thermal coal cost has been gradually going down now. So that was one of the reasons where the margins were quite low in Q3. Going forward, with the duty removal and the China coming back, and the good thing is with energy prices cooling down, the Europe is back into the market. So we're very inclined to start exports again. At the moment, we are selling everything domestic. We're hoping to start exports soon.
Okay. Soon is how soon?
Probably say Q1 of next financial year.
Got it. And you also gave us guidance. I think you said volumes of 7 million tons in FY24?
No, 7 million. So our capacity is 2.7 million tons. So quarter-wise, we produce about 7 lakh tons. So we maintain that volume in the next financial year as well.
So, Abhishek, just allow me to come back to the margin question just one more time. While you said that, of course, things will improve going forward, can you put a number to it? Last year, you were at just about, just under 31%, 30.7%. This quarter, Q3, you were at 11.8%. Q2, you were at 7.6%. So what's a range that we can perhaps work with for the next few quarters?
If everything goes well, say about 80 to 20% for the entire year going forward.
Okay, 18 to 20%. Got that.
Okay,
Yeah.
18 to 20% in terms of margins. Abhishek, coming back to the exports, you were saying that, that will pick up once more. Can you tell us what the sales mix will really look like? Because prior to the export duty, Nigel is alerting us that you did have around 70% from the export market. Is that correct? And is that a number that you look to go back to?
What Nigel mentioned was totally correct. See, at the moment, domestic prices are quite strong. And since, Europe is opening up, China has opened up. So I don't know whether the number is going to go back to 70%. We are very much open for exports. But as a company, as a profitability, we will look to sell where we get the better realization. So it might be domestic, it might be exports. We need to look forward and see what happens.
Okay. Abhishek, talking about your FY23 guidance, on iron ore pellets, your guidance was 2.7 million tons. In the first 9 months, you've done 1.9 million tons. So are you on track to achieve your guidance of 8 lakh tons?
See, so we got the permission from 2.04 to 2.7 in the middle of the year. So accordingly, we ramped up our production. This financial year, we should be able to achieve, say, 2.6, 2.625 tons. And next year, we will target 2.7 million tons.
2.6 to 2.62. And iron ore mining, your guidance was 3.05 million tons. You've only done 2 million tons in the first 9 months.
We should be somewhere about 2.7 million tons this financial year.
Out of time now. Abhishek, thank you very much for joining in. That's Godavari Power Ispat for you. With that, we're out of time on Trading Hour as well. From the entire team, thank you for watching. Stay tuned. Halftime Report is up next.